Dell is down after hours due to their latest earnings. It is down 10% to $127.30 a share. Let's go through these earnings right now and see if it is a buy or a sell. So we have here the 9 months ended and the 3 months ended. This is the prior year. 2023 revenue was 22 billion. That is up slightly, up 10%, to 24.3. 9 months ended 66.1 to 71.6. So revenue is up. Is profit up? Well, we have the profit here up slightly, 1 billion to 1.2, and in the 9 months ended 2.03 to 2.9 billion. So that is up as well. Next, we'll look at the free cash flow, which is cash from operating activities minus capital expenditures. Cash from operating activities is down 2.1 to 1.5, and that was previously 7.1 to 3.9. Then this is CapEx here, 700 million to 639, and in the 9 months it is down slightly as well. So if we also, Dell and ICE, they give us the value so we don't have to add them up like ourselves, but free cash flow, cash from operating activities minus CapEx, 900 million compared to 1.4 billion. So that is down. So is it a buy or a sell? We're going to look at my automated stock valuation spreadsheet. I've already put the ticker Dell in here. It loads up the company financials, but we will just put in the most recent numbers here, and then we can use these numbers to see. So you can see here these numbers will change. If I put in the most recent quarter, which was 24,366, you can see the total revenue is up slightly. Net income was what was it again, 1127, and free cash flow was, I'm doing this on my other screen, you can't see, 914. So yeah, free cash flow is down. So revenue, let's have a look at that first. Trailing 12 months, 93.95, higher than 24, but not higher than what it was in 22 and 23. Net income, what are they doing with this revenue? Is it more profitable? Beating 24 and 23, yes, 4.09 billion, but not as high as it was in 2022. Free cash flow, we saw it is down, and yes, 2.83 billion. 2024 was about 6, and if we have the breakdown here of operating cash flow versus capex, trailing 12 months doesn't work as exactly here, it doesn't have my most recent numbers, but we can see the decline in operating cash flow. Shares outstanding, what are they doing? Well, they are buying back their shares, rewarding shareholders, so that is good. And let's have a look at my discounted free cash flow model. So this is a way of valuing companies, looking at their future free cash flows and discounting them to today's value. For some reason, the value isn't returning here, but if I look at Dell's weighted average cost of capital, 8.85, so I'll just manually overwrite it here. And this gives us a calculated stock price of $75 a share. Quite interesting. So let's have a look at these numbers, see if we agree with them. Revenue estimates were expected about 95 and 96 billion, very small 1% growth. Let's see what analysts are saying. So they currently say average, they're expecting much higher growth, 97 and 105. So we'll be a bit more bullish. We'll go, we'll do the last year, we'll do 6%. Brings us to $90 a share. Net income margins, we'll take an average of these last 2 years. We'll be a bit more bullish here. Put this at about 4%. And this brings it up to $92 a share. And finally, the free cash flow to net income, free cash flow rate, all over the place here. Basically, if we were to not look at the most recent year and take an average, which was 230%, it would be about $107 a share. But as we saw, the free cash flow has not grown in the trailing 12 months because of this most recent year, and that is why it's down. So not a buy according to the discounted free cash flow model. Before I continue, please check out my Patreon if you're interested. Links are in the description, and the sheet here is for $5 a month, or you can help me out for $1.50, or don't. It's up to you guys at the end of the day. So, I didn't talk this through because I ran through it. Dividend. Dell does pay a dividend, 1.23%, meaning you get paid about $1.74 per share. Well, not about, you do get paid $1.74 per share each year. $3 billion in dividend, and it is not too safe actually. Well, it's relatively safe, but 70%, 75% free cash flow. I can't speak today, my apologies. 75% payout ratio on the net income, and free cash flow payout ratio over 100%. So that is not good. So not very safe at all. Dividend date is 22nd of Jan, so buy before then if you want to get paid your quarterly dividend. So we'll have a little look at the dividend discount model. Unfortunately, Dell's, we don't have enough dividend history here. So in a couple of years, in 2 more years, we'll be able to use this. The Ben Graham formula for intrinsic value. This is a way of valuing stocks. Looking at the earnings per share, which we have here, $5.91, AAA bond yield, corporate bond yield, and the expected growth rate. So analysts are expecting that Dell will grow at around about 20% in the next year. That is pretty good. Ignore the greens here, for some reason it's done that. But $137 a share is the fair price, a Graham price of 103, meaning it is a bit overvalued at the minute, according to Ben Graham. But fair value, if we go back to the charts, under what Ben Graham would say is the fair value. So that is quite interesting. So finally, we will look at the comparable company model. This is a way of valuing companies, looking at companies of similar industry sizes and looking at their revenue growth rates, EBITDA, net income, profit margins, price to sales, price to book, PEG, Peter Lynch's price to earnings growth, EV to revenue, EV to EBITDA, PE, and I also have forward PE in here as well. So I would say companies that I looked at last time was IBM, ticker symbol IBM, HPE, and Oracle. So this will load all the company financial data for these companies and we can have a compare. So we'll wait for it to load, 1 second. Enterprise value, Dell is the third smallest, Oracle being the biggest, and IBM than Dell. Revenue, highest revenue, 94 billion. Negative growth rate over the last 5 years, but all these companies apart from Oracle have that. EBITDA, second lowest. Net income, second lowest. Smallest profit margins, there you go, that's one reason there. 4.36%, Oracle 20%, IBM even 10%, HPE 6.4%. Price to sales, the market average currently is around about 3, so Dell is under that. Only HP and IBM are pretty close. Price to book value is about 5.27. Dell once again lower than that. PEG, Peter Lynch's price to earnings growth. Dell is the only one under 1. That usually means it is undervalued by Peter Lynch's metric. So now we have EV to revenue, EV to EBITDA, PE, and forward PE. Forward PE, one of the lowest, actually quite interesting. PE, lowest as well, but not a buy according to the PE or the EV to EBITDA. Only EV to revenue, where it is one of the lowest multiples there at $200, but an average brings it to 121. So interestingly, $121, pretty close. 137, and well, it was 100 on the bullish side. So all the models are saying that Dell is a little bit overvalued at the minute, and basically, if it pulled back, that $100 a share would be a buy. We need to go back to prices back to August time. But since then, it's gone on 27% growth. So quite interesting. Hope you guys enjoyed it. Subscribe if not already. Check out my Patreon, and I'll catch you guys next time.